Thank you, Granville. It's great to hear the different perspectives of people who've been in this space for a while and from different angles. So we heard the academic perspective from Renee, we've heard the industry perspective from Granville, and now I'd like to invite up to the stage Allison Lee, who has served in the regulatory space at the SEC for 17 years, including as the acting chair. So please help me welcome Allison.
Thank you for having me, and thank you to Renee for those disciplined, rigorous, thoughtful overview of corporate governance, and thank you to Granville for the intellect and passion that you bring to a really, really important topic. So thank you. Thanks to both of my fellow panelists. I'm really looking forward to the discussion here. So I'm just going to briefly hit. I'm going to kind of combine a little bit. I want to talk about regulatory uncertainty, but a lot of that uncertainty is around a lot of the things that we just heard from Granville, a lot of things connected to ESG and sustainability. I'm going to just hit three kind of big picture topics. First, I want to speak a little bit briefly about kind of the regulator's view of regulatory uncertainty, or at least my view, which is shared by some but not by all. Second, I'll touch on important differences between regulatory uncertainty and political uncertainty. They're connected, and one causes the other, but they're not the same thing. They are distinct, and I think it's important to discipline your thinking when you're looking at the two. Figure out kind of, is this a combination, is this one or the other, because it really does matter in terms of how you address it as a corporation. And then third, I'll offer some best practices that I have learned for businesses to undertake in the midst of regulatory uncertainty from conversations I've had with literally, no exaggeration, hundreds of C-suite executives in the US and around the world. So to start, what is the regulator's view of regulatory uncertainty? I think the downsides are pretty well understood. Right? I think everyone kind of instinctively knows delayed investments of all kinds, not just in regulatory compliance, but all kinds of investments get delayed. That creates a drag on the economy. Higher compliance costs as firms gear up for potential outcomes. You also get greater competitive inequality because the larger, more resourced firms can react more quickly. The smaller firms, those larger firms can better prepare, they can monitor, they can predict, they can even lobby for outcomes. You get valuation risks because analysts are going to apply a discount to industries and sectors that are subject to uncertainty in their rules. That can increase your cost of capital. That can, of course, depress share prices. Very importantly, you get an erosion of trust and predictability, as Granville was talking about. When you have unclear or shifting regulatory regimes, that weakens confidence in capital markets, and especially if laws are either quickly reversed or simply selectively enforced. That's a conversation I was having this morning with one of the folks here. And that can also, of course, damage international competitiveness because large multinational firms can shift their operations to jurisdictions where there are more predictable frameworks. So, but, there's always a but, and that's because all risks, believe it or not, I know many of you know this, have a flip side of potential opportunities. So I want to offer you there a few thoughts on kind of the less often discussed opportunities that arise when there is regulatory uncertainty. First, and most of these are the flips of what I just said, strategic flexibility and delay. You can delay some hefty compliance costs. You can delay certain decisions. There's like an option value, a real option from an economic real options perspective. There's value in being able to wait. You have time to analyze all the variables associated with a strategy before you irreversibly commit capital. So that's a small window potential there. There's regulatory arbitrage. When rules are unclear, firms can experiment, they can do pilot programs, they can even make business model changes that may later become restricted. There's the flip side of the competitive inequality, which is depending on the size of your firm. If you are a larger firm, more sophisticated firms, you can manage that uncertainty better and you can use it to increase your advantage over the smaller, less resourced firms. Not necessarily a good thing from a regulatory perspective, but if you're looking at it from a business perspective, it's the case. There's also, more often, opportunity to influence a regulatory outcome that is uncertain, right? What's one of the biggest examples we've seen of that in the last we'll call it 5 years. I bet most of you know I'm about to say crypto, right? I've never seen a more stark example of taking full advantage of what they at least called regulatory uncertainty. I didn't quite agree that it was as uncertain as it was asserted, but they amassed, they did all kinds of experimentation. It grew just dramatically. They amassed resources. They had lobbying resources. We saw all of that crop up, essentially as a result of what was called regulatory uncertainty and a willingness to take very, very high risks. From an investor perspective and advantage, those that are more skilled at predicting regulatory outcomes or assessing regulatory preparedness can find alpha in these markets. From a policymaker's perspective, and this one is key, and I experienced this personally, and that is it can encourage experimentation and data generation that later really informs better rulemaking. That is exactly what happened with the SEC's rule. All of the private work that came before that informed, and we were able to put out a much better, well thought out rule that many, many people were already familiar with. We had the benefit of TCFD, we had the benefit of SASB, we had the benefit of the GHG protocol and any other number of work and initiatives that were out in the private sector. So again, sort of a potential benefit of regulatory uncertainty. It's not without upside, but there is a tipping point, right? Persistent and especially arbitrary uncertainty really erodes trust in capital markets. That erodes capital formation and redounds to the detriment of our entire economy here and globally. That's why, in my view, regulators need to, generally speaking, be very careful to try to minimize regulatory uncertainty wherever possible. Next, I want to just take a moment to highlight the difference between regulatory uncertainty and political uncertainty. We've heard a lot of discussion here about both. And I think with businesses in particular, it's important to think carefully about the difference. Political uncertainty, of course, like I said, can cause or lead to regulatory uncertainty, but it's definitely what's happening today, but it's different. And it presents a much broader and more complicated set of risks for businesses to analyze. It's captured in broad indices, right, like exchange rates, interest rates, investment flows, market volatility, and of course, very importantly, reputational risk. So however difficult it is to navigate regulatory uncertainty, I say it's tenfold times more difficult to navigate political uncertainty, especially of the type that we're seeing in the US right now. And as has been, as Granville, I think, discussed, we have an administration now that's willing, and at least for now apparently able, to in many ways dictate what it wants in the marketplace. Despite having a stance against regulation, this isn't regulation that's done by due process with comments and adoption and votes by bipartisan commissions. This is just a top-down direct interference. We see it with Intel, we saw it in the steel industry, we see it with the granting or the withholding of federal funds based on either political views or sometimes, I would argue, even potentially worse than based on political views, arbitrary whims that are absolutely unpredictable. So those are thorny issues. They require very careful analysis, and they require expertise of all kinds. That's all hands on deck type situation. So that makes cross-operational work within a business so much more important. You need to be drawing on every single department. You need to make sure you're drawing on all that expertise. It's being shared, and then the people at the top are able to sort of synthesize and kind of make top-down decisions. So in some, companies are extremely and rightly concerned about political uncertainty. Let me just tell you a couple of quick examples. There's a recent think tank analysis that found that in 2025, the US CEOs, maybe this is no surprise, but they are less concerned about ESG regulation and where it's going to land, and they are more concerned about the political backlash and anti-ESG sentiment. Now, I'm not suggesting anything about their politics. I'm simply suggesting this is what their focus is on as they make business decisions, not what regulation is coming down the pike, but what's the potential, what am I going to do with this, can I lean into it? Should I shy away from it? You know, kind of how do I deal with that? And that, I think, coincides very well with another very recent study out of, I think, Bain Consulting that found, maybe not surprisingly, again, that CEOs speak less in general. They speak less about sustainability, for sure, but they increasingly link sustainability-related issues to enterprise value. So they're doing something they call the do versus say gap, big gap between what they're doing versus what they're saying. But notice the important distinction here, and this is why I raise it. Regulatory uncertainty can provide all kinds of opportunities to get involved, to raise your voice, to shape outcomes. Political uncertainty often, and in today's environment, I think for sure, has the opposite effect. People are laying low. Management is keeping quiet. They want to keep their head down and stay out of the fray. They don't want to see their company's name on X or on Truth Social. That's a recipe for disaster. So it's really important to think about them a little bit differently as you're thinking about how to navigate them. The last point I want to make about political uncertainty, and this comes from my involvement. I'm on the board of a nonprofit that's been around in Washington for 30-something years called the Center for Political Accountability. So I'll just disclose up front, but it's a nonprofit. They're doing fabulous work. But here's the thing: you need to know if your firm is making political contributions, either directly right out of your treasury or indirectly through dark money or even trade associations. And you'd be surprised how frequently companies don't know that. Here, let me just pull, I just lost my notes here. And I see some interesting Trump headlines. Let's see, I don't want to get distracted. But it's because those contributions and where they can end up can be traced right back to the doorstep of your company, to the surprise of the CEOs and the board. And let me tell you, the thing they are surprised about is not that it was traced back to them. They're surprised it occurred. They don't know, right? They do not know if and how political money is being spent, and that is a terrible place to be. And that's why, again, little plug for CPA, they have a model code that companies can adopt to kind of help them govern this entire process from top to bottom. So I'm not advocating for any particular approach to politics, to political contributions. I have my own views, as you might imagine, but I am saying companies must be very careful and have good governance over what its policies are regarding political money and how those policies and strategies are being implemented and monitored. You need good governance over this area now more than ever. Last, the third topic I'm going to address is advice or thoughts for business leaders amid all of this uncertainty. And this comes mostly from, as I said, these conversations I've had with boards, with CEOs, with those who advise boards and CEOs, and also from my own experience before I went to law school later in life. I was in business for many, many years, in the oil business, in fact, before I became a lawyer. So here I want to focus on regulatory uncertainty. And the reason is because that's an area where there's a lot more experience and expertise. A lot has been built up. There's a lot of common wisdom in this space around kind of how to deal with it. And I think, in fact, I'm certain the number one thing that I've heard over and over is how important it is to stay laser focused on the risks and the opportunities. Got to always remember, with every risk, there is a potential opportunity that are authentic to your business. And you got to be straightforward and honest about that. You want to do a solid, traditional kind of heat map analysis, like a probability magnitude analysis for those risks and those opportunities, so that you at least know where to begin thinking about these things. Some of these things are going to fall within an ESG framework. Others, like AI, cybersecurity, are arguably outside it. But the idea is it a true risk, a true opportunity for your business, and do you have the tools and the strategy to address it? And here's where I think there are many who may miss some of these risks and opportunities. It's such a fast-moving landscape. So, for example, just this week, you may have seen that JP Morgan has announced that it intends to invest $1.5 trillion over the next decade in sectors that it believes are critical to national security. So that means supply chain, to JP Morgan, that means supply chain resilience, energy independence, strategic tech like AI and quantum computing. Those are all opportunities that could show up in your analysis, depending, of course, on kind of the specific company. From a risk perspective, again, just some examples for how easy it can be to not kind of key in on some of these things. Just yesterday, again, in the Times, reported that China is not just disrupting supply chains, but they say China is weaponizing supply chains, right? That's a pretty serious situation. They're placing global restrictions, and I'm not trying to demonize China because the US, of course, has done this too in the past. I'm simply saying it's a very important risk to be thinking about. They're placing global restrictions on critical minerals that are used in computer chips, cars, missiles. It's extraordinary. And it's rooted really in a response to the US and in US international regulation. So also on the risk side of the equation, this one is somewhat obvious, but not always, I think, well internalized. There is a massive and looming transfer of risk going on from insurance companies onto society at large. It's massive, and it's happening in this like slow-moving avalanche coming down a hill. By some estimates, every 10% rise in climate-related claims can result in anything from a 5 to maybe even a 20 or 25% rise in premiums every single year, year over year, because of course insurers reprice every year. So I don't want to go too much farther into specifics here. I just want to highlight a couple of areas where I think there's a large majority of businesses that have both upside and downside exposure, and they aren't all as carefully aware of that as they need to be. That's why I think this deep dive is important. This kind of deep dive on identifying these risks and opportunities is a no regrets move that every business can take in the middle of regulatory uncertainty, and I think some of the smartest business leaders in the world are doing exactly that. But let me take a step back and talk about what they do next. What should a company be doing next amid regulatory uncertainty once you've really analyzed where you are in this landscape? So first, you want to be proactive. You don't want to be led around by regulation. You don't want regulation to be the thing that makes the decisions about your business model, about where you go. Of course, you have to take it into account, but unless or until it's there, you really want to be proactive. You want to be flexible and proactive. So what do I mean by that? Let's think about compliance frameworks, and climate is a really good example of that, because think of all the different regimes that are building up, being torn down in different areas all over the world right now. You have a number of firms, and here I'm not going to put in a plug for anybody, but you have a number of firms where they have these products that are modular, that you can build like a modular ESG type data system that can anticipate the CSRD. It can and did anticipate the US SEC rule. It can anticipate the California rules, the ISSB, which has been adopted in over 30, I'm not sure what the number is at this point, jurisdictions around the world. They're all running on separate tracks in separate modules so that you can build them up, bring them down, you can pilot them, you can get rid of them, but eventually the idea is you integrate them if and when you need like a unified approach. But until you do, you sort of build these things out in a modular way. I've heard over and over from folks inside corporations, especially chief sustainability officers, but also, I'm missing the word now for the ones that are inside the finance function, officers. And I'm sorry, what? Yeah, that's right. So it's funny how you just lose these. That's why I'm looking around. Somebody help me. But at any rate, this is what I've heard frequently from these folks, and I think it makes a lot of sense. Another point, I think you need to consider investing in regulatory intelligence. With the advent of open source AI, it's much more affordable and easy to do. You can subscribe to services. No dog in this fight, but they're out there. LexisNexis, Diligent, Fiscal Note, they're everywhere. And, this is another kind of no regrets move. It may sound obvious, but even folks like myself, I'm saying I've lost count of this. I don't know what the status is of that. It's very hard to keep track. This is a fast moving landscape. So regulatory tracking, so that you can follow on a daily, weekly basis where things stand with litigation and with potential rulemaking, I think is very important and can be aided through the use of these AI-enabled trackings. You should absolutely also do scenario planning. I know a lot of firms do this, but what I mean here is conduct exercises to model potential regulatory changes and regulatory outcomes. Let me give you a really good example here. With the Inflation Reduction Act, when it was first adopted, but before the implementation rules were known, you saw several US solar firms modeling at least 3 versions of what was going to end up being a production-eligible threshold. And then later, when Treasury clarified what they meant by domestic content thresholds, firms that had modeled the strictest case were ready to certify early, and they got a first mover advantage. So scenario planning, extremely important with regulatory uncertainty. And then last, of course, but not least, to bring it full circle, strengthening governance around all of this. Especially in times of both regulatory and political uncertainty, you need to ensure that you know who is responsible for implementing these functions. It's well-resourced, they're well-coordinated, there's communication going on, and it's carefully monitored, at least at the C-suite level and possibly also at the board level, because in the end, identifying these risks and opportunities, thinking about how to navigate them, all of that can and almost certainly will go awry if you don't have the right governance structures in place. So with that, I look forward to the discussion. Thank you.